Good afternoon, good morning, good evening, depending on when you're going to be watching this video. My name is Leanne Nidecker, and I'm with First National Bank in Fort Smith in the Trust Department. First National Bank is trustee of the Boast Inc. 401k retirement plan, and I'm going to be discussing with you the retirement plan, the features, the forms, the benefit, and we're going to be going through all of that so that you understand the benefit that's being provided to you by Boast and the opportunity you have to save for your own retirement. If you haven't already, you should be receiving a form packet that you can reference when you watch this video as I go through the forms and explain the features, and we'll go ahead and get started. The first thing I'm going to do is talk a little bit about the plan. The plan is sponsored by Boast Inc. Eligibility for the plan is 1 year of service and age 21. The entry dates for the plan are January 1st and July 1st after you meet the eligibility requirements. The 401k feature is part of the overall profit sharing plan. It's not a separate plan per se. And one of the things I would like to mention, and one of the questions you need to ask yourself is, do you think Social Security is going to be available for you when it comes time for you to truly stop work and have the ability to retire? If you don't think Social Security is either going to be there when you reach the retirement age, or what is going to be paid to you might not be enough for you to pay your bills and have a comfortable retirement living, then you need to give some thought to participating in this retirement plan. This is a benefit that Boast is offering that is allowing you to help you save for your own retirement. What you would do is you have the ability to have amounts withheld from your check and put into the retirement plan to be able to earn money on a tax-deferred basis. Boast historically has matched contributions that you put into the plan. So not only are you having money withheld from your check to save for your own retirement, then Boast is also assisting you in saving for your own retirement. The salary deferral contribution limits for 2019, it's 100% of compensation or $19,000, whichever is less. It's on a pay-as-you-go basis through payroll deduction. You may elect to defer a percentage or a fixed dollar amount. You can change your 401k deferral as of the first day of each month. Now, because this deferral or salary deferral or 401k contribution is withheld from your check on a pre-tax basis, what that means is the amount you put into the plan is not subject to federal or state income taxes as it goes in. So there is a tax savings immediately. So let's say, for example, that if you earn $25,000 a year at Boast and you elect to put $5,000 into the retirement plan, come tax time when you get your W-2, you're only going to pay income tax on $20,000 in Box 1 taxable wages instead of the full $25,000 of your gross salary. Like I said, you can defer a percentage or a fixed dollar amount, so it'll be a percentage of your gross compensation, or you can decide to, do $5 a paycheck or $20 a paycheck. You can change it as of the first day of each month. So, the new employees that are coming in January 1st of 2019, if you decide that you want to check the box and not participate in the 401k program at this time, and then you think about the material and you've thought about it and you're like, oh my gosh, I really should have participated to get the company match, you can fill out a new deferral form and elect a percentage, and that will take effect at the first of the month following once that form is turned in. For those folks that are age 50 at the end of 2019, and you do the deferral of $19,000, you are eligible for what's called a catch-up contribution of $6,000. That has been put into play by Congress and the Department of Labor because people in their 20s and 30s were not saving for retirement as they should. And so it's allowing people that are 50 or older to sort of catch up on their retirement savings. Again, it's going to be contributed through payroll deduction. You can defer a percentage or a fixed dollar amount. You may change your catch-up contribution as of the first day of each calendar month. The employer does provide for a discretionary matching contribution. In order to receive that matching contribution, you must, number one, have participated in the 401k plan and elect to have money withheld from your check. The other thing is you must be employed on the last day of the plan year, which is June 30th, to receive a matching contribution. Each year, the employer announces the matching rate. For the plan year July 1st of 2018 through June 30 of 2019, the matching contribution rate is dollar for dollar up to 4%. So if you put in 1% of your compensation as a 401k contribution into the plan, Boast is going to match 1%. You put in 2, they put in 2. You put in 3, they put in 3. You put in 4, they put in 4. You put in 5, Boast is only going to match up to 4%. And again, you have to be employed on the last day of the plan year in order to receive that matching contribution. What will happen is on a per payroll basis, the money withheld from your check on a per payroll basis will be sent to First National Bank and the Trust Department to be invested on a per payroll basis. The matching contribution will come one time a year. So after the plan year June 30 closes, and once we know who is employed on the last day of the plan year, Boast will match you for the entire year that you participated in the 401k part of the program up to 4%, and that money will be sent in a one lump sum. You are always 100% vested in your 401k contributions. The money that you put into the plan is 100% yours always. The matching contribution is subject to a vesting schedule. Boast has put a vesting schedule in to encourage retention, and then in order for you to be able to vest, in other words, that money be 100% yours should you terminate employment, you will need to have worked with Boast for 3 years in order to be 100% vested in the matching contribution. That is 3 years from hire date, not 3 years from date of participation. So for all the new employees that are coming in January 1st of 2019, you are not starting the vesting from January 1st of 2019. Go and look at your original hire date. If from your original hire date up until the next year, if you've worked 1,000 hours, you're going to receive vesting credit for that. So it does back up to original date of hire, and most everybody that is coming in January 1st will already have 1 year of credit for vesting purposes. You're going to receive quarterly paper statements on your account. Those will be mailed directly from First National Bank. There are in-service distributions and hardship distributions available from the plan. These are features that Boast has turned on to the plan to allow you to have access to your money before we have what's called a distributable event, which means that you've either terminated employment, become disabled, death, or you've reached normal retirement age. The 401k plan, this retirement plan, this is long-term. This is a long-term mechanism for you to save for your own retirement. It's not meant to be like a Christmas club or a savings account. So the Department of Labor has basically restricted the ways in which you can have access to the money. So some people are very hesitant about participating in the 401k part of the retirement plan, thinking, what if I really need that? What if something happens and I really need that and I don't have access to it? Well, Boast has provided 2 ways for you to have access to your money. One is the in-service distribution. If you are age 59 and a half, you will have access to all or a portion of your plan monies to do with what you wish. The hardship distribution is really in the event of what's called a severe financial hardship. An example of that is unreimbursed medical expenses, college tuition. A little later on, we're going to talk more about what qualifies as a hardship distribution. So if you're hesitant about participation and that you might, what if I really need the money? You do have a mechanism for you to take it out earlier than, termination, death, normal retirement, or disability. The maximum you may receive allocated to your account for 2019 is $56,000. It includes 401k salary deferral, any company contributions, and forfeitures. You must file a beneficiary designation for the plan. Be sure and update that form if your marital status changes. The last thing you would want is if you fill out the form and you name your wife or husband and they become an ex-wife or an ex-husband, if you don't change that beneficiary designation upon a divorce, then the ex-wife or ex-husband is going to receive the money. So be sure and keep your beneficiary designation current. You're going to have several investment options in the plan to invest your 401k deferral contributions and your company contributions. We're going to talk about those. You can change your election on a daily basis, and we're going to discuss about why you don't want to do that. You're also going to have access to the services of ProInvest. ProInvest is a third-party independent investment advisory firm that gives investment guidance, advice, and account management solutions to retirement plan participants. That is all they do. They're 100% retirement plan participant oriented. You're going to be able to access the retirement planner to determine your retirement goal, and then you can receive recommendations regarding investment selections to increase your probability. You can access the service through the bank's website and then click on the Relias icon, or you can call them at the number listed on the plan highlight sheet. You also have access to your plan balance at the bank's website. Your initial user ID will be your Social Security number, and the initial password will be the last 4 digits. You're going to be prompted to change both of those upon login. There is not anything you can do to the website that is going to break it, so please go out there. You can view your transactions. You can do an on-demand statement. You'll be able to see when your contributions come in. There's going to be a personalized rate of return. There's not anything you can do to break it. At the very bottom of this plan highlight sheet, what's most important is if you have additional questions or need to discuss this further, don't hesitate to contact myself, Leanne Nidecker, at the number listed, and there's my email address, or Barbara Bethel, who is listed. Please feel free to contact us with any questions you may have. What I'm going to do now is I'm going to go through all the information that's in your packet and the forms that you need to complete. The forms are going to be due Monday, December 10th by 3 p.m. in HR. That is in HR by 3 o'clock. Don't put it in the inner office mail at 12 o'clock on Monday and expect it to find its way to HR. So the forms are due back Monday, December 10th by 3 p.m. in HR. The first form in your packet is what's called an elective deferral enrollment change form. It's the yellow or the goldenrod color. This form must be completed even if you choose not to participate in the program. If you choose not to participate in the 401k part of the program, in other words, you don't want anything withheld from your check and put into the retirement plan, then you need to fill out the name, Social Security number, address, and you will check the box that says, I elect not to make elective deferral contributions, and then you will sign and date this at the bottom. This is the only form that would need to be completed and gotten back to HR by Monday, December 10th. If you are going to participate in the program, then you need to make an election. And you can do that by completing either A, I elect a % per pay period, B, I elect a dollar amount per pay period, or in the event of a bonus election, that is option C. So option C would be if BOST were to pay a bonus, which I don't know whether they pay bonuses or not, but if they were to pay a bonus, if you leave option C blank, nothing will be withheld from your check with regard to a bonus election. And what you do in A or B does not have to be the same as what you do in C with regard to the bonus election. So let's say, for example, you elect to do 4% per pay period. In option C, you could elect to do 100% of your bonus or 50% of your bonus. And as long as the two elections, what you do in A and C is less than $19,000, then you are fine. The catch-up contribution in the second part of this form is only going to apply to those individuals that are over age 50 and are deferring the maximum amount of $19,000 for 2019. And as I said on this form, that the contributions are not subject to federal, state income taxes. The contribution goes into the plan. They are subject to Social Security and Medicare taxes. So if you were to put in, and think about this, if you were to put in 4% per pay period, and let's just say that's $50. So you're going to put in $50 per pay period. And because it's 4%, BOST is going to match that $50. So you put in $50, the company is matched $50, so you've got $100 into your retirement plan, and guess what? It didn't cost you $50 in terms of your net check. So because the 4% is before taxes, your net check is not going to be reduced by $50. It's going to be reduced by something less than that. Your net check may only be reduced by, $40 or $38, depending on the tax situation. So you would have put $100, you would have put $50 into the plan. BOST is going to put $50 in the plan. So you've got $100 in the plan, and it only actually costs you in your net check something less than $50. It could be, $45, $38, depending on your tax situation. If you have any questions about this particular form, don't hesitate to give me a call at First National Bank, and I will repeat that number when I get to the end of the presentation. So this is the deferral form. Even if you don't want to participate in the plan, you're going to check the box, I elect not to make elective deferral contributions, and this must get back to HR. Now that you've decided to participate in the program, at least up to 4% of your compensation, so you can get a 4% match from BOST, you must fill out a beneficiary designation. In the event of your death, First National Bank needs to know who is going to receive your retirement benefit. So this beneficiary designation, you're going to check the box whether you're married or not married. If you are married, you must name your spouse as the primary beneficiary. If you do not name your spouse as the primary beneficiary, then your spouse has to consent in Part 3. And that spouse's signature needs to be either witnessed by a plan representative or notarized. If you are not married, you can name whomever you want as the primary beneficiary. If you have more than one beneficiary listed as primary, then we will assume that it's split evenly among the primary beneficiaries unless you designate a different percentage. You will name a contingent beneficiary or beneficiaries. The contingent beneficiaries are only going to be paid in the event your primary beneficiary has predeceased. If you are considering naming minor children as your primary beneficiary, I want you to please call me at 788-4346 so we can discuss how we want to handle minor children as primary beneficiaries. Again, this beneficiary form needs to be completed if you're going to participate into the plan. You will write your name, check whether or not you're married. If you are married, you must name your spouse 100% as the primary beneficiary. If you do not name your spouse as the primary, then the spouse needs to consent, and that signature either needs to be witnessed by a plan representative or that signature needs to be notarized. You will name a contingent beneficiary. The contingent beneficiary will only be paid in the event that the primary beneficiary has predeceased. The next form is the investment election form. You filled out the form and said, I'm going to participate into the plan. I'm going to have 4% withheld from my check. We now know in the event of something happens to you, who's going to be the beneficiary of those funds. And then now you have to make an investment election. So the next form in the packet is the investment election form. The form consists of a menu of mutual funds. The mutual funds were chosen by First National Bank. So these funds were chosen because they are a good mix, gives you a diversified mix to create your own investment portfolio. These funds have had a reasonable, steady rate of return, and they are low-cost funds. With regard to this form, you will either elect to engage ProInvest to manage your investments, and we will talk about that further. If you elect to engage ProInvest to manage your investments, then you are just going to simply check this box and sign and date this form. You do not have to make a decision about this menu of mutual funds. ProInvest is going to make that decision for you based on some parameters. If you choose not to utilize ProInvest to manage the money for you, then you must make an election amongst this menu. You can, put all your money into one fund, or you can divvy it up amongst a mix of funds, but the numbers need to be whole numbers. Do not fill this out at 7.5 and 6.8, nice round numbers, and they must add up to 100. And you're probably chuckling to yourself thinking, why on earth did she say that? I've seen it. I've seen people fill out this form and they put decimals in there. I've seen it come and it didn't add up to 100. So here's the menu of mutual funds for you to choose from, and we're going to talk more about those to educate you on how to make an investment decision. Use nice whole numbers. It must add up to 100. If you don't want to make the selection with regard to the mutual funds, then you would check this ProInvest box and sign and date the form. If you don't check ProInvest, you have to make an election here and sign and date the form. So if you have any other questions with regard to the investment election form, don't hesitate to call me. Now, the magic with regard to the colored paper, there's no magic to it other than if it's colored, it must get back to HR by December 10th at 3 p.m. All the colored pieces of paper would need to be filled out and get back to HR. If you are not going to participate in the plan, only the 401k deferral form needs to get back to HR. If you are going to participate in the plan, all the other colored sheets have to be filled out and gotten to HR. This next sheet in the packet is the mutual fund investment summary. Now that you need to make an investment election, you're going to look and say, well, I don't know about Vanguard 500 Index Admiral shares. What is that? What does that mean? Well, this sheet right here is telling you about the investment choices. This sheet tells you how that investment choice is invested. How much is it in the stock market? How much of it is in the bond market? How much of it is cash? Does it pay income? So the rule of thumb with regard to investing has been, if you take 100 minus your age, then that's how much you need to be invested in the stock market. That's how much you need to be invested in equities to provide for growth. The stock market, you hear it on the news, it goes up, it goes down, it goes up, it goes down. Historically, over time, studies have shown that investing in the stock market historically has always had a better rate of return, or in other words, you've made more money over time being invested in the stock market, even though it does this up and down thing, than in the bond market. Because if you are younger, your time horizon is long, and because your time horizon is long, you can withstand to weigh the ups and downs and what the stock market is doing. I mean, if you are 28 years old or 35 years old, you are not going to need this money. So big deal that the stock market takes a dive, because you're not going to need it for 25 or 30 years. You can withstand and wait out the recovery. Now, if you're closer to retirement age, and you are in your, early 50s, mid 50s, late 50s, you are not going to want to be as aggressive in the stock market because your time horizon is shorter. You are going to need to take advantage of that money. So what this sheet is going to tell you, it's going to tell you how aggressive a fund is. And the more aggressive the fund, the more better chance for a bigger rate of return, but then, you have to withstand the ups and downs of the market. So for example, Vanguard Life Strategy Conservative Growth Fund, which is the first fund on the sheet, it's telling you that the assets are invested 40% bonds, 20% in short-term fixed income, and 40% in common stock. If you like that asset mix and you're comfortable being 40% in the stock market, then this fund is what's called a lifestyle fund. You can put 100% of your money into this fund. It's a one-stop shop. You won't have to do anything else. And the fund manager will keep this 40% mix in the market. Vanguard Life Strategy Moderate Growth is 60% in the stocks. Vanguard Life Strategy Growth is even more aggressive with its 80% of its assets in stock. The other funds, Vanguard Balanced Index Admiral, is 60% in stocks. The Vanguard 500 Index Admiral, Mid Cap Admiral, Small Cap Growth, Total Stock Market Index, Equity Income Admiral, Fidelity International Discovery, those are all basically 100% equity type funds. They're 100% in the market. It's just what sector of the market are you in? There are two bond funds, Fidelity Fidelity Investment Grade Bond Fund and Vanguard Short-Term Grade Bond Fund, and there is one money market fund. This is the sheet you would use to determine how aggressive you want to be, how much in the market you want to be. Is this mutual fund investment information summary. The next part in your packet is what's called a rate of return sheet, and it looks like this. This rate of return sheet basically tells you, is this fund making money or not? What are the fees associated with this fund? The part one of this particular sheet is the performance information, and you'll see that this sheet is grouped by balanced funds, equity funds, bond funds, and money market funds. The type of option tells you whether it is a life cycle fund or a balanced index. It'll tell you what sector of the stock market you are in, and then it shows the average annual total return as of 9/30/2018 for a 1-year, 5-year, 10-year, and since inception. And you're thinking, okay, Vanguard Balanced Index Admiral, as of a 10-year period, the average annual total return was 9%. So what? Is that good or bad? I don't know what that means. I don't know how to measure that. That's what this other column is, this benchmark column. This benchmark as of 9/30/2018, that's your yardstick. That's your measuring stick of how you know whether a fund is good or bad or doing what it's supposed to do. So in the Vanguard Balanced Index Admiral example, that over a 10-year period it did 9%, when you look at the benchmark over a 10-year period, it did 9.1. It's in the ballpark. If, for example, you were looking at that fund and it had an average annual total return of 9% and the benchmark was 11%, give some serious thought about whether or not you want to put your money into that particular fund. Again, this is retirement money. This is the long haul. So when you look at these returns, you can't think of it in the short term. You need to think of it in the long term. So look at the 5-year return. Look at the 10-year return. Look at the inception return to help you make these investment decisions. Like I had stated earlier, the Vanguard Life Strategy Conservative Growth, Moderate Growth, and Life Strategy Growth, they're all life cycle funds. They're meant to be a one-stop shop, depending on how much in the stock market you want to be, how aggressive you want to be. The second part of this rate of return sheet is the fee and expense information. The mutual fund companies don't do this because they love everybody and want everybody to make money. There is a fee associated, they charge fees associated for investing in their funds. This section here tells you what the mutual fund company is charging in terms of an annual operating expense, or whether or not there are shareholder type fees. Rule of thumb with regard to an annual operating expense or an expense ratio, 1% or higher is considered to be more of an expensive type fund. So when you look at the total annual operating expenses, and again it's grouped by balance funds, equity funds, bond funds, and money market, you will see that all of these are less than 1%. Most of them are less than 0.50%. So let's translate that in terms of dollars. So for every $1,000 you have invested in Vanguard Life Strategy Conservative Growth, the fund company is charging you $1.30. And when I say the fund company is charging you that, they're taking it out of the dividends that they pay you. So that is not something that you would directly see on your participant statement, but it's something you need to know in terms of what the fund company charges are in order to make an informed investment decision. The shareholder type fees, all of these funds don't have shareholder type fees, meaning front end loads, back end loads. Does it cost me to trade in there? It costs me to get in, it costs me to get out. Is there any kind of origination type fee? So those are shareholder fees. All of these funds are, the shareholder type fees are NA with the exception of Fidelity International Discovery. There is a short-term redemption fee if you sell it within 30 days of purchase, but because this is retirement plan money and you shouldn't be doing that, you're not going to pay the 1% charge. So this sheet right here tells you, okay, here are the funds. Are they making money or not making money? What kind of return are they getting? And here are the fees associated with those funds. So that is the rate of return sheet. And also let me say that with regard to these funds were picked by First National Bank for their steady rate of return and the fact that they are low cost funds. And we monitor the menu of mutual funds to make sure that we're picking the right mix. The next part of the packet has to do with the annual statement of disclosures. I am required by law to give this to you. The Department of Labor has decided that participants are not making informed investment decisions, mainly because they don't understand the fees that are associated with the investments in their plan. So this annual statement of disclosure is giving you general plan information, telling you about the fees with regard to the mutual funds or any other fees that the plan may have, so that you can make an informed decision. The first part of this annual statement of disclosure is just general plan information. It says, guess what? You have investments in the plan, there are fees associated with it. In the investment instructions, you're responsible for choosing how to invest your money in the retirement plan. What portion of your account can you invest? You're going to invest your entire account. How often can you change investment options on any day the New York Stock Exchange is open? You can transfer money between investment options on any day the New York Stock Exchange is open. Don't do that. This is not day trading. This is long-term. The designated investments. The plan provides for designated investment alternatives. That is a Department of Labor term. That is the same thing as this menu of mutual funds that we've talked about. On the back of this page, it talks about investment managers, and we're going to talk more about the investment manager. The investment manager that's provided to you is you have the ability to hire ProInvest to manage the money for you. And they're going to take care of making the investment election. They're going to take care of rebalancing your account. They're going to take care of all that. And they will do that for you for a fee. And that is 0.6% of the market value of the account if you hire ProInvest to actively manage your account. So if you have an account valued at $10,000, the annual fee would be $60 a year for investment money management, and it's going to be charged on a quarterly basis. Administrative expenses. There are administrative expenses associated with having a retirement plan, such as trustee fees, legal fees, accounting fees, record-keeping fees. The administrative expenses could be charged to your account on a pro rata basis. What you need to know is traditionally these expenses have been paid by the plan sponsor, which is Boast. So in addition to Boast providing the benefit of allowing you to save for your own retirement and having a matching contribution, they're also paying the administrative costs directly. So what that means to you is you're not going to see when you get your trust statement, you're not going to see that you've been charged for an accounting, your share of an accounting fee or your share of the trustee fee. So you have a better rate of return. In other words, your money is making more money because it's not going to be reduced by the administrative expenses of the plan. There are individual expenses associated with the plan, and that would be charged to you individually. One would be taking a distribution. So if you terminate employment and request a distribution, that's $25 a check. If you utilize the hardship distribution feature, that's $25. If you utilize the in-service distribution feature, that's $25 a check. If you hire ProInvest, that's 0.60% based on market value. In the investment options, the investment options section just tells you, guess what? If you want to have adequate savings, it depends in large on how you choose to invest and save. It's going to talk about the comparative chart. And here's the comparative chart that helps you figure out what you need to do with regard to your investment options. The comparative chart that I'm referring to is this rate of return that we've already talked about. So when you go back and you look at this packet and you look at this sheet that we've talked about that I call the rate of return sheet, and you're like, what on earth did she say? This doesn't make any sense to me. You can come back to this annual statement of disclosure. You can go to the next to last page where it says comparative chart part 1 and comparative chart part 2. That's telling you how to read the model comparative chart, which is the same thing as the rate of return information. Part 1 shows the performance for each investment option under the plan. It's showing you the benchmark over time periods. In other words, the yardstick of whether that plan is doing well or not. You need to have a well-balanced, diversified investment portfolio. You don't want to put all your eggs necessarily in one basket unless it's one of those life cycle funds, which that's what it's designed to do. For the comparative chart part 2, it's going to show the fee and expense information. It's going to show the annual operating expenses, and it's going to tell you whether or not there are shareholder fees. So if you don't remember how to read the rate of return sheet, you can just come back to this and it explains that. So that is the annual statement of disclosures that I'm required by law to give to you. The next part in the packet, now that you're probably going, oh my gosh, she just talked about investments, I don't know what she means, I don't want to think about it, I don't want to do anything, is ProInvest. ProInvest is a professional money management company. And so the next part in your packet has to do with who ProInvest is and what they do. What they do is they allow you to have a professional money manager for a very low cost. They're going to actively supervise your assets. If you elect to have a managed account, you're going to complete a retirement analysis and it'll determine your goals. And ProInvest is going to actively manage account based on your age and your risk tolerance. So someone younger is going to be in a more aggressive mix of the menu of mutual funds. Someone older is going to be less aggressive because their time horizon is short. When I say that they're going to manage your account, what they are going to do is they are going to create investment mixes based on this menu of mutual funds. They are not going to go outside of the mutual funds that are listed here. They are not going to try to sell you anything at all. All they're there to do is they're going to take the menu of mutual funds and they're going to create different models with that to help you achieve your goal. How you get to the ProInvest website to get to the retirement planner, because not only do they have a retirement planner, they have a lot of educational pieces about retirement. They have a newsletter. If you go through the retirement planner, it's going to ask you questions about, okay, well, when do you plan to retire? Do you want to include Social Security or not? Do you want to include your spouse's income? How much are you saving now? And all of those things come into play, and it goes and it says, okay, guess what? You need, based on what you've given me, you need $750,000 to retire at age 65 based on your current level of savings, and you have a 30% probability of achieving that goal. So it's a very, very eye-opening experience, and the things you can do to increase that probability is you can work longer, save more, be more aggressive in your investing, or spend less in retirement. And all of those things can be tweaked as you go through the retirement planner to look at the different investment options you could have, change how long you want to work, change how much you want to save, say, oh, I want to be more aggressive with my investing. All of that is free. So you can go through the retirement planner, get educated, look at the tools they have available. That is totally free. It won't cost you a thing. It's only when you hire ProInvest to actively manage the money for you is there a fee. It doesn't cost Boast anything to provide the service. So Boast First National has partnered with ProInvest. It doesn't cost us anything. We don't get anything from ProInvest. We have done our due diligence with regard to this service. So it doesn't cost Boast anything to provide it. It's a good service to allow you to have a managed account if you don't want to learn about investing or do that on your own. What they will do when ProInvest manages the money for you, they are going to make an investment election for you based on your age and your risk tolerance. And when I say they're going to do that for you, there is a link. ProInvest is going to send that investment election directly to First National Bank. They're only going to utilize the investment options that are available under the plan. The portfolios are constructed based on that menu of mutual funds, and they have several different models that are age and risk based. So there's like 42 different ones, and they're age based. So I personally use ProInvest with regard to the bank's assets, because even though I could probably figure it out, I don't have time to monitor it. I don't have time to rebalance my account, and I really don't want to think about it. So ProInvest is going to make the election for me. As I get older, it's going to slowly tweak that election, and I'm not going to be as heavily invested in the stock market as I once was. So even though I'm an aggressive investor, Barbara, whom I work with, she's also an aggressive investor, but because she's older than me, her mix is different than mine, even though we're both aggressive investors. So that's where the different 42 portfolios come in to be able to better target where you are in life with regard to investing. There's going to be quarterly rebalancing. Studies have shown over time that if you have the discipline on a quarterly basis to rebalance your account, and you have that discipline to go and do that on a quarterly basis, year in and year out, that over time you reduce your risk and you increase your rate of return. And what I mean by rebalancing, let's say you make an investment election of 50% Vanguard 500, and 50% International Discovery. Over time, as the market does what it does and dividends pay, you will no longer be 50-50. Let's say International Discovery is 60% of your account balance and the other one is dropped to 40. Then what ProInvest is going to do is they're going to sell the one that's at 60, bring it down to 50, buy in the one that's 40, bring it back up to 50, which is the name of the game. You want to sell high and buy low. That's what you get with ProInvest. There's information here. There's a little Q&A with regard to why you want to utilize ProInvest, what they do they consider an investment, other investments, you know, how often can you make changes, that kind of thing. You can hire and fire ProInvest at any time. So if, for example, you have the deer in the headlights look and it's like, oh my gosh, gotta have all this stuff back, you can choose on your investment election form, you can say, you know what, let me try them out. I'm gonna engage ProInvest, I'm gonna hire them, and after you see what they do with regard to your investments and the fees that they charge, if you don't like them, fire them. And then you're only going to pay the fee for the time that they actively managed your account. On the flip side, if you're going to do the investing yourself and you say, okay, I think I can do this myself, and then you look and you're like, ooh, I didn't do a very good job for myself, you can contact ProInvest and hire them. If after you look at the managed accounts with ProInvest and the little Q&A, if you have any other questions, don't hesitate to contact me. The next form in the packet is the ProInvest form. Even if you don't want ProInvest, complete this form and check the box that says, no, I do not want ProInvest. This allows Bose to know that you were offered to have a professional money management and you chose no, that you don't want to at this time. If you do want to utilize ProInvest, then you're going to fill out the form, and you have two ways to go about it. You have option 1 and option 2. In option 1, that is the customize my account. If you check that box, ProInvest is going to contact you to develop a customized investment plan. You're going to go through the planner, you're going to talk about it, you're going to go through it with a ProInvest representative, and then the ProInvest will actively manage the account. In the Do It For Me option 2, ProInvest is not going to contact you. They're just going to actively manage your account. That way you don't have to deal with it, and they're going to do it based on an age-based portfolio. So if you don't want it if you want to be a little more aggressive or conservative, then you're going to check one of the other boxes. So let's say, for example, if I were to do this, they're going to put me probably in a moderate based on age. Well, I want to be more aggressive than that. I want to take risk. So I would do aggressive based on age. You can also, in the Do It For Me box, say, go ahead and set my account to be managed. Do it on in a moderate age-based portfolio, but go ahead and call me, and then we're going to talk about it later. So there's two ways to do it. You can either do it option 1, customize my account. They're going to contact you. You're going to go through the retirement planner, and you'll visit about it. Or you can do option 2, Do It For Me. It's going to be in a moderate age-based portfolio unless you tell them otherwise by checking a box. And even if you do that, you can still talk to them by checking the other box. Go ahead and set my account to be managed. If you don't want ProInvest, check the No, I don't want ProInvest box. If you check No, I don't want ProInvest, then you have to come back to this investment election form and make a decision with regard to the menu of mutual funds. The very last thing in your packet has to do with what I call the summary plan description. The summary plan description is basically the features of the plan in layman's terms. On this sheet, there are two what's called summary of material modifications. The first one has to do with changes to the hardship distribution. After that, there's a summary of material modification that has to do with the changes in a disability termination. And when you get to the very, very back, that's the summary plan description. Most of what's in this packet we have already talked about. And what's the purpose of the plan? It's a means for you to save for your own retirement. Who's eligible to participate? The employees who are age 21 and completed 1 year of service. When can I enter the plan? July 1st or January 1st after you meet those requirements. How much can I contribute to the account? How much of a catch-up contribution? How often can you change the amount you put into the plan, which was monthly? How much is the employer going to contribute in a matching contribution? And so on and so forth. Most of this we've already talked about. The only thing I want to point out is on page 5 of the summary plan description. For those of you that were concerned about participating in the plan, if you, well, what if I really need it? Page 5 discusses what qualifies as a severe financial hardship. Deductible medical expenses incurred by you, your spouse, or your dependents. The purchase of a principal residence. Post-secondary tuition and fees and room and board for the next 12 months for you, your spouse, your children. To prevent eviction from or foreclosure of the mortgage on your home. Payments for burial and funeral expenses for you, your deceased parent, spouse, children, or dependents, or your primary beneficiary. And expenses for the repair of damage to your principal residence that would qualify for the casualty deduction. The law has changed that, and now it has to be declared a disaster by the president. So there's the summary plan description. I have completed everything in the packet. Again, if you have any questions regarding the packet or anything I have said in this video, don't hesitate to contact me, Leanne Nidecker, and my phone number is 479-788-4346. My email address is leannenidecker@fmbfs.com. Don't hesitate to contact me or email me. All the forms must be due December 10th at 3:30 NHR. If you are not going to participate in the part of the program, this elective deferral form must be completed, and you check the box, I elect not to make elective deferrals. If you are going to participate in the program, you have to complete all of the colored pages and get back to HR. Thank you so much.